underwent a radical shift after the dramatic collapse of IL&FS in the month of September 2018. NBFCs are now being criticized for taking undue risks while chasing growth. Some economists have recommended an asset quality review of NBFCs in order to weed out the good from the bad. The NBFC sector, of course, plays a very critical role in the credit flow and lending to unbanked segments, so a speedy resolution is of essence. But the question is the worst over for the NBFC sector? What is the road ahead? To discuss this, I'd like to bring on stage Mr. Dinanath Dubhashi. He's the Managing Director and CEO, L&T Finance. Rajiv Sabharwal, Managing Director and CEO, Tata Capital Limited. We also have Mr. Keki Mistry, who is the VC and CEO, HDFC. And Rajesh Sharma, Managing Director, Capri Global. This discussion is going to be moderated by my colleague, Abha Bakaya. Ladies and gentlemen, a round of applause for our panelists.
Good evening, everyone. I know this is a session that many of us have been waiting to engage with, simply to really hear perhaps where we stand after we've seen a tumultuous time for the sector, and who better than the panelists that we have here today to address that. In the last year, the headlines have, if anything, gone from bad to poor, and while we've all been trying to find a silver lining, there have been serious issues that we continue to grapple with. Mr. Dubhashi, let me start off with you then. Where do we stand now? Where do we stand currently versus all of what's happened over the last year or so?
So, I would like to point to two things. I have been in this sector for about 12 years, and there was a time when this sector was perhaps the poor cousin of banks. I am talking about NBFC. Let us not talk about a few companies like HDFC at that point of time, which were very different. But otherwise, very clearly, it was considered to be the netherworlds of finance. Whatever banks don't do, they do. From there now, I think the sector has graduated to people actually being in dialogue that because the NBFC sector is not doing well, the economy is not doing well. I'm not supporting that argument. But the very fact that NBFCs are being taken, the names of NBFCs are being taken in that context shows the increasing importance of NBFC to the overall economy. And various growth rates, etc. are showing that. That is over the last 10, 12 years. Over the last 1 year, if I have to point out one difference, it is, say 1 year back, everything was being painted with one broad brush. From there, very clearly, clarity has emerged. Whether there are various divisions, whether NBFCs which are AAA, NBFCs which are promoted by large groups, very clearly in terms of not only perception, but availability of funds, the way the investing public looks at them, very clearly there is a differentiation. So I would put it as a continuum. I would not put it as whether the crisis is over or not. But on the continuum, there is way more clarity now, and rumors and fear-mongering has way less space than what it was 1 year back. So I would look at it as the last 1 year as a very positive move. All problems are not solved, they need to be solved. But definitely we are at a much better place than what we were 12 months back.
Mr. Mistry, I do want to get a sense from you on where we stand, but I also want to add some context. I mean, if we look at the panelists that we have with us here today, all of the brands that you represent and the kind of companies we're looking at, no one has really been saying they have a problem, and yet we know there is a problem. So how would you identify, the pain points that still exist?
I think the main point which exists today is the risk averseness which has set in. I think that to my mind is the fundamental problem we are facing today. There is so much of risk averseness which is there that even within NBFCs, there are some very good NBFCs, there are some not so good NBFCs, and there are some very poor NBFCs. Now, the very good NBFCs are getting funds with ease, really with ease, compared to where interest rates were a year ago. The cost of funding has come down a lot. The very poor NBFCs obviously are not getting money at all. But even the middle category of NBFCs who perhaps would not be so bad, there is so much of risk averseness that is set in with banks that they are not getting money. And the way many of them have been surviving over the last 1 year is selling their loans. Their assets are loans, so they are selling their loans, raising liquidity and using that liquidity really for paying off their liabilities rather than for creating new loans. So creation of new assets is really where the problem is. We are not creating new assets, and by and large, and because new assets are not getting created, in a way, NBFCs used to reach out to a segment of the market that banks don't reach out to, historically. And that segment at this moment is not getting funds with the same ease as they used to before, which is possibly, to some extent, creating a shortage of job creation.
Okay, very, very strong points made there. Mr. Deshpande, let me bring you in, because it's true, the asset liability mismatch really caused a lot of problems for the sector, and in evening that out, there has been a lag. Where do you see us standing currently? And, have we moved away from the crisis of, of any further potential crisis to addressing the cleanup and moving forward?
I think this cleanup is always a process. I think what has happened over the last year and a half or so, as Mr. Mistry mentioned, there is fair amount of risk awareness which has come in terms of lenders. But what we are seeing is that there is a clear segmentation which is happening. There is a set of lenders who are getting money. They're getting long-term money, large amounts of money at fairly low costs. And then there is a set of people who've been supported by the private equity people in a strong way. They always have worked with low leverage and there is no problem. And it's somewhere in between that the challenges exist where the liquidity has been tight. I don't think so the problem as far as liquidity is concerned for them is over. It will take a longer period of time. But also there's another factor which we need to keep in mind. It's not only about supply side. It's not only about money being available to lend. We need to have a good set of borrowers to lend to. I think so. What we are also facing a challenge is there is money available, but there is dearth of good demand. While demand is there to an extent, but at this point of time, when there is some amount of slowdown on growth, there is more risk averseness from the lenders also, because they want to be sure that whom they lend to, they are good borrowers and money will come back. So you tend to get a little more conservative. So I think so it's a combination of, in certain pockets, liability is not being available, but also because the demand is not as strong.
Okay. We'll talk about demand because I think that's the biggest sore point. But just to touch on what you've also brought up, with regards to the job market souring, till now we haven't had a problem with regards to delinquencies and at a certain level. Do you see that now becoming another issue to deal with for the sector?
I don't think delinquency is obviously a problem when the economy slows down. But I don't think it's going to be a problem which is going to be, unmanageable or anything of that sort. That's my personal view. And I think the markets are at this moment distinguishing between the good players and the not so good players. And the market is providing funds to the good players, not providing funds to the not so good players. So markets in any case are distinguishing between the good and the bad. So I think there was, when your commentator first came on, there was a reference to AQR. My personal view is that the markets already are distinguishing between the good and the not so good.
Okay. So let's probe a little deeper then, Mr. Dubhashi, on two counts. Firstly, the demand problem, how severe it is. When do you see the pickup? When do you genuinely see the pickup? And we talk about this on a regular basis, but we don't want to hear that it's going to get better next year. Do you actually see signs of things improving?
Okay, I will again take it from two sides, as Mr. Mistry said, the supply side and the demand side. The supply side, I am actually very hopeful. What was wrong, let's say, a year back? Especially, I will talk NBFC sector mainly. There is a large part which is the bank side, but let's talk about NBFC side. NBFCs, generally speaking, were taking a risk that they were not supposed to take, which is transformation risk. That borrowing short term and lending long term. Right? This is no good NBFC should ever take this risk, and it was being taken. we actually hope that these lessons are learnt. Normally lessons learned last for just 2-3 years, but we hope this time the pain was so much that the lessons also will be learned for a longer time. This 1 year has been the correction year, where people who could raise money, long-term money, have raised long-term money, replaced short-term. As Mr. Mistry was saying, some people who could not raise have sold their assets and corrected. So generally speaking, if you see the top 50%, or at least not 50%, but let's say top 25-30 NBFCs have got this right now. And hence, when the demand comes back, the balance sheets are in a better shape to support that growth. So as I said, from supply side, actually I am quite hopeful, quite optimistic. Let us talk the demand side. Demand side, let us split into sectors. If you talk retail, if I just split into rural and urban, leave out the dialogue which is going on about excessive rains and spoiling of kharif, etc. The truth is that the rural demand is as much dependent on reservoir levels, irrigation, groundwater level, that on monsoon. And I think all those early indicators are positive. Rural welfare in forms of houses being available, toilets being available, medical attention being available, insurance being available, has changed systematically. And hence, once this little bit of the cyclical downturn in rural goes away, and which there are good indicators that we may be seeing green shoots in rural, I am very hopeful of the rural demand turning first. Right? Urban, yes, there is a problem in housing, there is a problem in SME, especially after the GST and things like that. I would think that's some time away, especially SME, and hence the self-employed demand in housing will perhaps be some time away. But I believe the early fillip to the economy and demand will come from rural sector.
So on that note, let me get Mr. Sharma in then. Mr. Sharma, what do you think? You've been saying that you already see the signs, but is it too soon perhaps for it to be significant in terms of demand coming back in the rural space?
Yeah, so we have seen the demand of the smaller loan is coming back, and in the age Mr. Dinanath said, the rural side demand we have also seen that from September onwards is coming back in the smaller ticket size. While the supply side is also improved, but demand side we have seen, while it was dropped in the first half, second half we have seen the clear revival. And we see the demand and consumption pattern improves. The demand will be come back, and hopefully we see good time again soon.
Okay, what about housing? That's continued to be a sore point. Yes, there's been a lot done in affordable housing. I think we were discussing this earlier, that at least a lot of steps that the government have been trying to address that segment. How do you see 2020 for the sector?
See, when you talk of housing, you have to break it in two categories. One is the retail side, one is the residential side, the other is the commercial side. Commercial is doing fine, has been doing fine, and will, to my mind, continue to do fine. When you look at the residential market, you have to further break it in two categories. One is the affordable housing segment, and one is the higher end market. The affordable housing segment has done well. My sense is the inherent structural demand for housing in that segment is so high that I don't see any concerns on growth or on demand. It's in the high-end market, or in the slightly high-end market. I don't mean the 10 crores and 20 crore properties. I mean even 2 crores, 3 crore properties that we have a problem. We have so many projects all over the country which are stuck, which are 70% done, 80% done, and are not getting that last mile funding. One of the reasons for that is that historically when a project was undertaken, a developer would tie up 75, 80, 85% of the funding. The remaining would come from sales. So he would sell property whilst it was under construction and use that money to do the last mile funding. Now, for a variety of reasons, people are not buying under construction property, and therefore that last mile funding which developers used to get, they are not getting anymore. And that is the reason why projects are done 70, 80% not getting completed. Now, there are two ways to address it. One way to address it is through the fund structure, which I think I must compliment the government. I think it's a very, very positive thing. The 25,000 crore fund which has been created would be a huge help for the real estate sector by and large. But at the end of the day, instead of just one fund providing the funding that is required, an ideal situation to my mind would be if all the lenders in turn would go and provide the last mile funding. Now, there are so many projects which are stuck where there is still a lot of equity which is left, where there is still a lot of cash flow that is left in the project. But nobody wants to fund that project because the regulations today say that if a loan is an NPL in someone's books, then anybody going and providing that last mile funding, even if the money is completely earmarked, completely sort of segregated, proper security is taken, notwithstanding all that, the loan has to be classified as a non-performing loan. So nobody provides money for these projects. That's what we need to address, because it's a real estate sector which creates jobs, and jobs lead to income, income leads to consumption, consumption leads to faster GDP growth.
So the RBI governor this morning right here, in fact, was, saying that, or admonishing gently the NBFCs, saying that liquidity is more than enough, and I think we've all acknowledged that, and saying that they have to start lending, that we have to start seeing lending on ground. Now, many of you have already touched upon reasons why that's not happening. But, when do you see demand? Let's not focus on, as you said, the other aspect. Yes, we know there's a cleanup. We know times have been tough, that companies have been risk averse. But when do you see enough demand to really boost that confidence and get lending going again?
See, if you divide again the consumer demand, Mistry spoke about housing, but if you talk about the rest of the demand, there is strong demand on the consumer side in certain sectors. If you look at the growth on the credit card side, the personal loan side, or the affordable housing, you still see a growth in double digits happening across for the whole industry. If you look at, we've seen some revival in demand on the tractor side, on the rural side too. The microfinance industry still continues to do well. So there are certain sectors within the consumer side which are doing well. Obviously, there are some sectors like auto and two-wheelers, where there has been some amount of slowdown. But there are other sectors which are doing well. So I feel what is happening today is, especially the smaller ticket, consumption-led lending, it's still doing well. Where it is a question of investment for a longer tenor, that is where there is some amount of slowdown which has happened. And if you look at the way the government has addressed the affordable housing, they've done a fabulous job of addressing that issue, whether it's on the demand side or on the supply side. There are incentives being given to developers to bring out housing of that nature. Customers are being given incentives in terms of lower interest rates, where actually their cost of acquisition comes down by 15 to 20% of the money which they have to pay for the house. LTVs are higher, 90% LTV is allowed. So there are a number of things which have been done to address that sector. I think, once this whole issue of moving to BS6 and some of these things get addressed post-March, we feel that the growth will be back. In fact, my strong view is this, that, we will start seeing growth coming back in Q1 calendar year of 2020. And from then, we will see better things happening. We hope that the way government has supported the corporate sector in terms of lower corporate income tax rate, and we are hearing that if there's something which could happen to give more money in the hands of consumers, that will be a good potent combination to get growth back.
There has been talk of a window, but do you also perhaps feel capital adequacy ratios should be raised, liquidity margins? Is there more the regulators can do, or is it really more about a broader economic revival?
No, I don't think, I think everyone has played their role, whether it's the government, whether it's the RBI. I think raising the capital adequacy ratio for housing finance companies is fine. To my mind, I don't think that's a big concern. I think the only point, as I said, is that how do we deal with these stuck projects? And if we can ensure that banks and NBFCs lend money to these stuck projects and get them completed, then I think it will go a long way in reviving consumer confidence.
It's true. If I may just add, if you look at the amount of money which is stuck in projects, in real estate, this number, different numbers are quoted around, but if it's 3 lakh crores, that itself is large. If you look at, what's happening on the power sector, or for that matter, what's happened on the renewable energy side on Andhra, some of these issues have to be resolved quickly. If they are there, then a lot of monies which are lying there unproductive, if they come into the productive stream, I think we will see a multiplier impact.
What do you perceive as the role for NBFCs as we move forward? Once we leave the crisis behind us, are they going to be viewed in a different light? It could actually be a better light. Is there a bigger opportunity now for them in the new environment?
Look, as I said a few years back, the role of NBFCs, and I'm talking about the larger NBFCs, and I will talk about the smaller in a minute. The larger NBFCs also, the role was supposed to be something which banks don't do, right? I think if you take the lending, if you take customers, even if you take employees, that gap between NBFCs and bank is blurring, or in fact it has blurred, right? NBFCs, the main role will be not be universal. Banks are universal. NBFC role will be to find their mojo, find what is the business that they are good in. There is no risky or less risky business. You have to understand the business. You should not be doing everything. You see NBFC after NBFC coming down to their core. They will be good in certain core, and supporting that core, moving with that core is the important thing. Let us not even talk just about the growth, right? Let's take this growth or lack of growth last year in perspective. If you take sector after sector, let me talk about tractors. Tractors have had positive growth for the last 4 years. And it was given that there is going to be 1 year in which there is going to be a negative growth. Every sector has to wait for a catch of breath. And we are actually quite sure that next year the positive growth is going to come back. And NBFCs will be, according to me, in these specific areas where NBFCs are large, like tractors, it is Mahindra and us, the two largest NBFCs. Housing, of course, there is HDFC. So these are specific sectors where, let's take real estate, developer funding. There will be NBFCs who can do it better than others. They will have a DNA better than others. If a NBFC has gone into that business just because the margins are high, there will be a problem. If they have gone into that business because they understand business, yes, they will do well. So these are the very specific roles. NBFCs will not be in broad-based lending, in very specific expertise lending. I think NBFCs, especially large NBFCs, have a role. Then we come to the smaller ones. And there are times then the smaller NBFCs are just treated, put under the carpet by saying the top 50 NBFCs give 90% of the credit. That's not the point. The 10% of the credit is really at inclusion level, at absolute grassroots level. And these NBFCs, I don't know whether 10,000 are needed or 1,000 are needed, I don't go there, but they are also very important. And it is important that some way the flow of credit to these NBFCs start. This FLDG scheme which government has put, it is not useful for the larger NBFCs, but definitely I believe if the smaller NBFCs, which now it is BBB, use it and they start getting funds, the real nimbleness, the real on-ground work can also restart, right? I mean, we are different, we are perhaps more nimble than large banks now, but at our size, we are not as nimble as maybe 100 crore NBFC or a 50 crore NBFC will be. And they have their roles, and very clearly we have to work to make them work as well. So that's
Okay, we're completely out of time, but I do just want a quick closing comment, Mr. Sharma. The framework has changed. As Mr. Dubhashi is saying, how do you see roles for different kinds of NBFCs evolving? You yourself are in that space. If you could just leave us with some closing comments.
So I think Mr. Dinanath said correctly, every NBFC is to find their niche where they good are. Actually, who they are, what exactly they wanted to do and which they want to pursue. Anybody who is doing in their niche area where they have control on the cost and they understand the sector will continue to do well. Simply following somebody else's business model without having the niche and expertise, I think they may not do well. So I think all NBFC, whether smaller or medium size, they have to realize that they have to find where they have built their niche of their team and everything else.
Okay. All right, I think Mr. Mistry would like to take that question, if it's possible. Would you like to just, I don't know if we have a mic, but if you could just perhaps, shout it out.
Well, thank you for this very optimistic session. Light at the end of the tunnel, and very often NBFCs save the day for most of us investors, small-time investors. And I'd like to thank you for sparing no effort and leaving no stone unturned. But, however, there's one concern. I don't want to single any of my friends here and put you on the mat. But there's one thing that I'd like to request you, that you need to revisit some of your processes.
Okay.
Yeah, your
right.
back-end
All right,
processes,
so, all
please.
right. Okay, we were
As far
actually
as the
hoping
paperwork
it
is
was a
concerned.
question, but thank
Yeah,
you
thank
anyway.
you.
Thank you. I'd like to thank the panelists, Mr. Mistry, Mr. Sharma, Mr. Dubhashi, and Mr. Sharma. Thank you so much for joining us today. It was fantastic having all of you on the panel.